All right, so I want to kick things off and I want to share with you how do vertical spreads kind of work and how do they make you money? Ultimately, how do they just function and behave to where you're able to profit? So that's what we're going to cover in this video. A lot of this content stems from what we're going on and doing in our courses. If you visit our tradersfly.com website, which you can see the link in the description below, we just launched an Options Mastery Verticals course. So definitely check that out. It is on sale and promotion until the end of the month, and you can go ahead and purchase it if you're interested in it. There's 18 hours right now of great training about vertical spreads, and there's 42 videos. So definitely check it out. And there's tons and tons of videos about trading verticals. So take a look. We've got a huge lineup of different strategies when it comes to verticals. So if you've never traded verticals before, but you've kind of dabbled into some options, you might be wondering, well, how do these things work? How do they behave? And how do they actually make you money? So at the base level behind trading verticals, we're going to go in. I'm going to show you how do they actually behave and function to where you actually make money. Okay, so let's take a look at this option grid and spread here that we have. This is the put side. We also have the call side on the other side, but really each spread has a form of value. Okay, and what a vertical spread, what we're doing here is we're taking one area here, okay, and we're either buying it or selling it. So what we're doing in a general case of selling vertical spreads, so if you're selling vertical spreads, what you might end up doing is, okay, well, let's say we sell the 260, okay, so we sell something. Okay, so in this case, the 260 strike, so here's our strikes, we sell that, that'll be $310. Okay, so we sold it, okay, but we buy some protection, maybe at the 240, for about $117. Let's call it $110. Okay, so we sold something for $310, we bought it for $110. Or in other words, you bought for $110, but you sold for $310. So in other words, the difference between that is what you potentially could profit from if everything stays kind of neutral and stays in line and expires without any issues. So watch what happens here. If I sell this one, sell the 310, buy the one at the 240, buy the one for about the 110 or so, and that leaves me with about $200 worth of possible profit. Okay, and then right here you can see $200 of profit. That'll be on the lower left over here. So let me compress this and you'll be able to see it. Okay, so you can see $200 in profit. The other way to do this is I'll break it down into individuals. So here it is again, 310, now it's 305. Analyze, and then let's do this one about the one, about the dollar. We'll buy that one. So look at what's going on. We're buying something for about $100. We're selling it for $300. Okay, they are different strikes, but buying one, selling one. Buying $100 worth, selling $300 worth. Okay, and at the end of it, then we could make $203. Now the issue is here we have to run through our obligations and legalities, and all that stuff has to go through its course, which means at expiration then all the dust settles. So at expiration, as long as everything kind of stays in line, that's where we make the $200. If it doesn't, then it pulls back. Then we have some liabilities and problems. But that's the way the verticals work, is that I buy something, sell something, and then if everything kind of stays in alignment, I'm good to go. Now, if it doesn't and it starts to go against me, now I get assigned or obligated at about the 260 in this case, because I'm selling the 260 and I'm buying the 235. So at 260, I get a little bit of a problem. I could get assigned, and then if I go past the 235 over here, then they would cancel each other out. But this is what selling a vertical is. Now, if you were buying a vertical, it's a little bit different. Let's say we're buying a call vertical. In this case, it works a little bit opposite. I might buy one right here for $490, okay, and then I sell one further out, right? But what I'm doing is the value that I'm buying, yes, I'm paying a little more, but I'm also selling a little bit higher up to offset that cost. So watch how this works. Okay, so I'll buy something for, let's go here, $295, okay? Then we'll buy this one for $915. So I'm buying a single call option, which means it's fairly expensive. It costs $915, but I don't believe the stock's going to explode to the moon. So then what I'll do is I'll sell something for $360, right? So I'm buying something for $900, selling another thing for $300, okay? And now the amount I pay is going to be only around that $600 range, right? So my risk, there it is, around 555. And then if it goes up, okay, now I'm actually able to collect about $945. But at the end of the day, this one's a little bit different because it has room to move up. So in this case, I'm buying something for 900, selling another thing for 300 and some dollars to offset the total risk, which leaves me with 555, which there it is, 555 as a max risk over here. Now, right now the price is here, and with time, this could continue to head higher, and then I could profit from it. But this is what you're doing: is you're buying and selling. That's the core behind this business, is you're just buying and selling. And if, as it moves, as long as it follows through, you're good. If this stands still and it doesn't work out and it doesn't move, then yeah, you could lose the full 555 here. So anyway, from a core basic, this is the vertical spreads. Now, there's a lot of different ways to trade verticals. I just showed you selling verticals and buying verticals out of the money. You could even set up verticals where, hey, I go in and sell a vertical on this side, where I'm selling some verticals, super cheap stuff, way out of the money. And then I could sell some more verticals over here out of the money. This is on the call side. Now I've got two verticals. I got a left side and a right side. And these verticals now create an iron condor. And then as you start overlaying things, let's say we go into 39 days out, I could go, I'll just show you this one. Let's say we go 230, 225. Okay, not making a ton on the premium here, but just to show you the concept, let's go a little closer to 235 and 230. Okay, so now what you'll see is I've got multiple verticals. I've got a vertical here, I've got another vertical here. So I've got different ranges, which means I've got some risk here and I've got some risk here, but I don't have all the risk in one spot. This is known as a risk array, which we talk a little bit about risk arrays with vertical spreads in the course. And what you see is we're starting to spread our capital amongst different areas. And I could set up and sell a couple more over here. Let's say this one, and then start adding more to that. And now I've got verticals in different zones, and I could have two contracts in different spots and one contract in another spot. So ultimately you're just spreading your risk in different areas. So anyways, there's a lot of power behind vertical spreads, and they could even be directional that you saw there, and we could combine it. So if you've never seen something like this, let's go in and let's say we buy a vertical spread here. Okay, and let's say we're doing like 5 contracts, okay? Well, instead of doing just 5 contracts right here, this one I say, okay, well, I could go in and, I'm paying $1,000 for it. And if it goes up, great. I'm holding about 31 shares or 31 delta. It's kind of like, in theory, a delta concept. But if it never gets there, I could also sell a little bit, a tiny vertical against it, okay? And sell like 4 verticals over here. And now I've got myself a little bit of cushion where, okay, well, I'm making a little bit of money. If it goes against me, I pay off a little bit of what I've got. But if it kind of keeps going up, then I'm okay. So anyway, that just helps reduce your risk. So now I'm only, at the most I'm looking to lose is about $948. Whereas without this additional vertical, it's about $1,100. So it allows you to trim risk in different ways. And I've got really a bullish condor here of a construction, a little more advanced. But my point is there's so many different ways to trade verticals, and we go over it in the course here. So check this out. Visit the website and go to tradersfly.com. Once you're there, you'll be able to scroll down, and then you can click that link and learn a little bit more about it. And again, up until November 30th, we do have a discount and promotion on this, and you'll be able to take advantage of it. And take a look. We've got 18 hours of training. There's trade examples in there. There's constructions and introductions to how to do different types of strategies. So there's different overviews there, and we're going to continue to expand the course and the material with some more trade examples as we continue over the next couple months, just to give different market conditions for some different examples. So I hope you join me. Check out the link in the description below, or visit the tradersfly.com website and check out that course. There's going to be tons to learn. You can also visit our website for a lot of great freebies. There's PDFs to download and many other training tutorials and videos. All right, so thanks again. Hope you join me and enjoy the rest of the week ahead. I'll see you next time.